Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending December 27th, 2019. So this was a holiday shortened week. Christmas fell in the middle of it. So I didn't really expect too much. Traders tend to take the week off and usually don't come back until after the new year. But you never know if something interesting or important is going to happen, and actually something did. So I'm going to keep this brief, but I'm going to share that with you. So first we have the S&P 500 here. It is just a daily chart, and we left off last weekend. Okay, that's a loss of momentum candle. So it's not too surprising on Monday and Tuesday, which was a half day over here, that we had very, very low activity. And in fact, if you looked closely at the S&P sectors, you could see that it was just index futures completely driving trade. And what I mean by that, it's kind of like there's no personality to the market. So usually S&P sectors will show some kind of bias, either like a cyclical bias, risk on or defensive. There was just nothing. Most sectors were tracking with the benchmark. So it was the futures that were driving trade, and that was driving money to the appropriate sectors according to their weight. Over here on Thursday, we did get a pretty good day up. This was kind of an interesting day. After the open, actually internals got really bad really quick. Here's what I'm talking about. This is the NASDAQ 100 in green, and this is the NASDAQ Composites Advanced Decline Line, and the NASDAQ 100 was the same. So usually they track pretty closely together. So this was the morning, and then it just tapered off, and small caps started to lag. So this was showing there was no participation in the market. It was falling off from the open. The market went up still, and that was all because of a handful of heavily weighted FANG stocks. Specifically this one, Amazon. So Amazon reported good holiday sales, and it got this monster move. So this was pretty much Facebook, Amazon, Apple, and Google that were driving the entire market. Everything else was like barely participating. And then over here on Friday, 0% close. So it looks like really nothing happened, which wouldn't be surprising. But something did happen. Remember that the internals and participation started to drop off Thursday morning, and trade was driven by very heavily weighted large market cap stocks, FANGs. And you could see this taking shape in small caps. They were starting to show relative weakness on Thursday. Now, on the week, there wasn't much sector bias either, except for consumer discretionary, because Amazon is the biggest component, so it outperformed, and technology, which is the most heavily weighted of the S&P sectors, which is why you get this big move when most stocks aren't participating. Now, Friday morning in the AM update, I mentioned a few things. I said, I think this is going to be a much more interesting day than I expected, because in pre-market, SP futures were up 0.3%, but copper was down 0.9%. Gold, which I'll get to, had been showing relative strength all week, and treasuries looked pretty strong. That led me to say something is up here. This is probably going to be a more interesting day than I would have expected, and it was. So here is what happened on Friday, and this is a 2-minute chart of small caps, or IWM. Here's Friday's open. So gaps up on the open, and look at this self, and this was on really heavy volume. IWM here. This is a bearish engulfing candle. So like you saw in that last chart, opens here at the top of the day and closes near the bottom. There was a little last minute ramp to get the major averages off their lows of the day, but they were set to close at the low of the day. So it didn't only engulf the prior day, Thursday, which was strong for the broader market, but it took out basically about a week of trade over here. That is a really, really ugly price candle. And here's the 1-minute chart again. Here's the open, opens up, sells off, and then into the close. Most of the averages were set to close at the low of the day. There was a little ramp that got them off the low, but let's take a look at the futures. That's the cash open. That's the sell-off. It was actually on pretty heavy volume compared to the rest of the week. And here's that last-minute ramp into the cash close. So you can see how they closed on Friday, the futures, pretty much near the low of the day, which is not a good sign for early next week. The last couple of weeks, there hasn't been a lot going on in 3C charts. The week before last was all about quad witching, options expiration, and prices were pinned for most of the week. And this week, really light volume and a holiday trading week. But actually did pick up a change in character here and some weakness on the futures. Let me pull up 3C real quick and move this chart out. So this is Russell 2000 futures. Over here is quad witching Friday. So you can see into this holiday shortened week, starts to diverge right into Friday morning over here, where we get the sell-off and close at the low of the day in the futures. And if we look at the Dow futures, again, here's that quad witching Friday. So you can see the same kind of thing developing here, where 3C is negatively diverging into this last Friday. Price action not as bad as small caps, but it is leading. The Dow has its own headwinds. Something else very interesting was the relative strength in volatility. So volatility, or VIX, was up 7% on the week. So here's the week, and you can see how it ended. And it wasn't only in VIX. Here's the NASDAQ's volatility index, up 13% on the week. And the relative price strength here isn't just this week. I think I had this in a video a couple weeks ago, but for members, you definitely know about this. This is December 16th. This is when we got a really unusual move in 3C over here showing underlying buying. And ever since then, volatility has shown a trend of relative strength, even though the S&P has gone higher over this period. And this positive divergence, as you can see, has stayed in effect this whole time. Check out VVIX's trend here of relative strength since November. This is just insane. This should be trading under 85 right now. So we saw relative strength again this week, and look where it's trading up around this $100 level. That is a level where you see a lot of volatility in price for the S&P 500, usually big swings, up and down. But when you get into this 110 and above 115 over here, this is like put on your crash helmet and get under the desk. The market is going to get nasty fast. VVIX has no business being up here at 100 with the S&P up as much as it has been in the last month. So let me show you a couple other things and then we'll wrap this up. The US dollar. I'm using UUP here for the US dollar. And you could see this just massive uptrend that's been in effect. With the Fed cutting rates and with their new QE and all that, it's been surprising that the dollar's held up as long as it has. You can see that is no longer the case. So a big change in character here in the US dollar from back here in 2018. This is a daily chart of GLD, and it's been acting fantastic on this time frame. You get, just really great price action, bullish consolidations, flag there, pennant here. But, gold hasn't done anything for 5 months, so people haven't been too excited about it. Well, that changed this week. So let's zoom in here. We'll take a closer look, and I'll walk this chart forward. So a breakout early in the week, and that was one of the more surprising things when the market was just kind of still earlier in the week, was that gold was doing really, really well. So this is a big change in character. It's a breakout. Remember that I was saying on Friday morning, it was a very odd looking market the way it had been behaving because gold had been performing really well and then copper looked really bad Friday morning. And that's why I said I think this is going to be a really interesting day. This is the copper gold ratio over here in red. This means that gold is outperforming, copper's underperforming. This is the 10-year yield. So just think of it this way. Copper is a risk asset. Copper is an industrial metal. Gold is a safe haven asset. So what you have over here is copper underperforming and gold outperforming. And in blue, you have the 10-year yield. Treasuries, remember, yields move opposite of bonds. This is pointing to a move down in yields and a move up in bonds. So my quick recap of the week would be this. Some really, really ugly price action in small caps over here. This is the daily chart, bearishly engulfing almost a week of price action over there. And although it did close off the low, which is better than closing at the low, as you saw, futures, Russell 2000 futures, closed at that low. And the reason I mentioned small caps is they tend to lead the broader market. And the sectors that we saw actually some weakness in this week were high beta and growth sensitive. That was semiconductors and regional banks. You can probably eyeball this December trend. Actually, I'll throw up a trend line real quick. And this is a 15-minute chart. So IWM, there's Friday's open, gaps up, sells off. So you can see this trend line is broken. That's the December trend line for small caps. It comes out of this big range that we had from 158 to 160. So that is a trend break in small caps. And then we have that strength in gold on the week and also in treasuries. And don't forget about volatility. And one other thing I want to point out about the way we closed on Friday, for a day that the S&P 500 and the NASDAQ 100 were down less than 0.1%, VIX was up 7%, NASDAQ's volatility gauge was up 12%, Russell 2000s was up 6%. The market has gotten extremely complacent, and this is not a time to get complacent. I pointed this out quite a few times. The market overall is in extreme complacency, extreme greed, hit 93 this week. That's like the highest of the cycle. Just as a reminder, this is where we were 1 year ago. These are contrarian signals. Here's the final chart. The CBOE's SKEW Index. I've covered this in the last couple videos, so you can check those out. It's been trading in this range all year, and we get this big move above 130 into 140, 150. This is really, as far as CBOE is concerned, the top end of the range. VIX is considered the fear index. This would be considered like the black swan index, hedging extreme downside risk by buying deep out of the money puts. The last time we saw a reading like this was back here in Q3 2018. Back here with SKEW above 150. A couple weeks later, that's when the S&P 500 sell-off of about 20% over 3 months And this is what I'm talking about. This is the S&P 500 daily chart backed up to that time period. So over here, SKEW printing at 159. Over here, SKEW printing above 150. Smart money was hedging against an unforeseen risk that everybody else was unaware of and was buying new highs over here. So do they know something we don't? Who knows? This is no time to be arrogant about the market or to be complacent. This is a time to simply be aware of what is going on out there. Unfortunately, in the mainstream financial media, you won't hear about this stuff until it's actually happened. Then they'll say, oh, well, there are signs here the whole time. That's a little late. Doesn't do you any good. That'll do it. Thanks for listening. If you enjoyed the video, please give it a thumbs up. Feel free to leave comments or questions in the comment section. I'll do my best to answer them. And if you would like to follow me on Twitter, I have a link for that below, and there is a link for the website. You can check out the memberships, or you can just check out the free posts that I post usually a couple times a week. Remember that the stock market will be closed Wednesday for New Year's Day. Members, I will see you on Monday. Have a fantastic weekend.